Right, so understanding stock valuation means that we have to keep in mind the three basic valuation models that we've looked at in class. Now, again, for this particular activity, we're going to be using Brigham Houston's Fundamentals of Financial Management in the 12th edition of their book. The chapter that we're looking at is chapter number 9. Keep in mind that we've done three different types of models. The first model is our constant growth model, the second model is our non-constant growth model, and the third one is our zero growth model. So we'll be looking at questions accordingly where we solve for each particular situation. Looking at 9-2, we can use a situation of constant growth valuation. So 9-2 says Thomas Brothers is expected to pay a $0.5 per share dividend at the end of the year. Now, this basically means that D1 is 0.5. Keep in mind that anything in brackets is a hint. Your understanding of the question itself should be able to tell you that this $0.5, when they're expected to pay this at the end of the year, that in and of itself represents D1. So D1 is equal to $0.5 per share. The dividend is expected to grow at a constant rate of 7% per year. That means that our constant growth rate is going to be 7%, and the required rate of return on the stock is going to be 15%. Remember, when you use this mathematically, you want to convert all percentages into decimals. Now, looking at this particular situation, we recognize that because of this constant growth rate, we'll be using the constant growth model. And to calculate the intrinsic value, or the price that we should be willing to pay for a share today, our model would be P0 equals to D1 divided by R minus G. Okay. Now, the thing to keep in mind over here is that each of these inputs have already been given to us. This dividend is provided, so that's 0.5 for D1. R is equal to 15%, so that's 0.15, and constant growth rate is 7%, so that's 0.07. Now, when we calculate this, you want to make sure that you do the denominator first, according to the order of operations. So 0.15 minus 0.07, that gives you 0.08, and of course 0.5 divided by 0.08 will give you a price of $6.25 per share. Ideally, you should not be willing to pay a single cent over this price for this particular stock. So this is the stock's current value per share. This is question 9-2 for constant growth valuation. If you have any questions, please drop a comment.